Now, if you look on your screen tonight, you will see that there are two handouts I prepared for you. One's called a guide to chart patterns, and the other is an intensive book from technical analysis from investing.com. Please download these now because they're not available in the recorded version. They're only available to people who come to the live class. So on your screen, you see the little download buttons. Click on those. They're called handouts. Click on those handouts and download them. And then you can move them around at your convenience to wherever you want to look at them later. Also in tonight's class, I'm going to be sharing a couple of presentations that I prepared for you. Now, these presentations are not recorded into the webinar because of copyright rules and regulations. The webinar doesn't copy pre-recorded presentations. So if you want to see these particular presentations that I've shared with you during the webinar, excuse me, you can go to YouTube. You know how to access YouTube. And don't do a search. Just go look for the channel that's called Forex and CFD Education. Don't do a search for that. Just look for the channel. So you would put in Forex, F-O-R-E-X, and which is the ampersand, you know, the little thing that looks like a music clef, and CFD Education. That's the name of the channel. Once you get to that channel, look under chart patterns and you'll be able to see all of these little presentations that I prepared for you. But also most of it's included in that guide to chart patterns. So let's get on with our class tonight on chart patterns and their interpretations. So chart patterns fall into the field that we call technical analysis. And technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of an asset reflects all the information about that asset, including market sentiment, as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for well-known chart patterns that emerge in share prices. For example, a head and shoulders, a triangle, or a wedge. Now, most people assume that the field of technical analysis is mostly or is made up of things like MACD and CCI and RSI and stochastics and trend lines and support and resistance levels and all of these indicators. That's only one small field of technical analysis. Chart patterns is another sector of technical analysis, because the fact is we could just call technical analysis chart analysis, because anything and everything we do on a price chart, including just reading the price chart, is technical analysis. So chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments. Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as price breaks key psychological barriers in the form of support and resistance lines. Now, there are numerous types of patterns, all named according to the shapes and on the price graph. We have triangles, channels, wedges, head and shoulders. We have pennants, we have flags. There's even one called a cup and saucer. It's all about these patterns that we find repeated over and over again, because it's not something we just make up and happens once. Triangles, which is my favorite chart pattern, happen over and over and over and over again in all assets. And the market reaction to a triangle is well established. So a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking, with a positive sloping support line and a price level that are squeezed into a corner. Ultimately, triangles are about, and you don't have to remember ascending, descending, and symmetrical. when you see a triangle, it's about the story of price being pushed into an apex, into the center of a triangle. Now, chart patterns do not tell us a direction. What they tell us is that something's going to happen as this price gets pushed into the smaller and smaller area, or the apex of the triangle. And this is why we call them breakouts, because they break out. Price will break out. Now it can have a breakout upwards or a breakout downwards. There's no way to really predict this. But once we get a legitimate breakout, there are many things we can ascertain from that breakout. We can judge the momentum. We can judge the direction. We can find entry points and exit points for a trade, all based on that breakout of the triangle and the width of the triangle. Now, there are specific variations of triangles that can occur, namely ascending and descending triangles. Okay. They're hard to spot, and like I said, you don't have to remember the difference. Okay, we can see over here a descending triangle. A descending triangle normally occurs in a downtrend, and we have a horizontal support line and a vertical resistance line, with the resistance line moving down to a straight support line. An ascending triangle happens usually in an uptrend. And then a symmetrical triangle, or just a triangle, can occur in either place. But the fact is, once you have a triangle, you have a triangle. So I've got a small presentation prepared for you. And it's going to explain to you a little bit more about triangles. And then we'll go on talking about the other types of chart patterns.
The symmetrical triangle pattern is formed by two intersecting trend lines of similar slope. These two lines are converging at a point called apex. The coiling of price that happens inside the triangle will eventually result in a breakout. The breakout can occur in any direction, and the move is often as big as the base of the triangle. The ascending triangle pattern is easily recognized by a rising trend line intersecting with a flat resistance line. It is often regarded by traders as a bullish pattern because the price keeps bouncing off a resistance line that may eventually be broken. That descending triangle pattern is formed by a descending trend line intersecting with a flat support level. The repeated attempts of the sellers to push the price down can result in a breakdown through the support line. In all cases, the stop loss can be placed beyond the opposite trend line. The stop loss distance can be at least as big as the distance between the trend lines, measured at the moment of the breakout. A good place to place the take profit level is considered to be as far from the breakout point as the triangle base is wide. Choosing the take profit distance a little smaller than the base width, if the risk-reward ratio allows it, can increase the chances of price reaching it. These chart patterns have no predictive properties, but they may give hints about the forces involved in the market.
So triangles are the most common of the patterns. And like I said, I use triangles in my trading all the time. In fact, let me pop you up some live charts, and we're going to look at some triangles that are actually taking place in the market right now. So here's a beautiful triangle that is taking place in Bitcoin Cash. And we're not here. I'm not giving you any trading tips. I'm not telling you trade. In fact, this is a one-day chart. Okay, so it's not even set up properly for short-term traders, for CFD traders, but this is the one-day chart for Bitcoin. And as you can see, price is moving into a beautifully well-shaped triangle. We had a small breakout here, but the breakout wasn't able to hold. In other words, the close was back inside of the triangle. So it didn't have the momentum to break out. And sometimes what we look at For breakouts, we want to see an increase in volume, or look and see where the support and resistance lines were. But we got a very red here. Now we're expecting, as price gets pushed farther and farther in here, that price is either going to break out this direction or break out this direction. We don't know. Okay. But that's all right if we don't know. When we get the breakout, we'll know which direction it's going. We're already estimating that if it breaks out upward, we're going to expect it to come up to 43.37. If it breaks out downwards, we would expect it to come into its trend line support level right here. But we don't know exactly where this breakout is occur, but we are now planning, because sooner or later, it can't just stay into the apex of that triangle. So as it gets closer and closer to that final little apex, you know it's got to break out. Okay. Now on this chart, we see a beautiful channel. And we're going to look at channels next. We're going to look at channels and rectangles right here. So we see that in the blue lines, the trading channel. Now, this price moved up and down in the channel. Look at all the time the price stayed and supported this channel all the way down here. Now, we were expecting when price came up here for it to break out and come to the bottom, back down to the bottom of the channel. But it finally broke out. Okay. When it broke out of this channel and we had verification of this breakout with volume, we had the candle that gave us the breakout, we then could have traded into the rally. And we could have measured, and I'll show you how we measure how far we expected the target level and where we would put our stop loss. But this is a perfect example of a breakout. The minute it broke out that channel, we had a perfect buy signal to buy, and we could have used the standard formulas to calculate our stop loss and our take profit. Your stop loss would have been placed at the bottom of the channel, and your take profit point would have been placed above the highest point at the beginning of the channel, and you would have had a beautiful trade. But let's go back a little bit and talk about this and talk about the other patterns before we talk about how you would actually trade them. So we have next rectangles and channels. The channel you just saw on the price chart, and a rectangle is simply, it usually happens in congestion or the stop of a trend, and price starts to move with a support line and a resistance line going straight across. From channels, and we have up channels and down channels. And again, you don't have to memorize all this stuff. You can call it whatever you want to call it. It's like we also have, I call rectangles boxes. Some people call them flags and pennants. Then we go on to wedges. And wedges are similar to triangles, that these patterns are formed between converging support and resistance lines. However, where the support and resistance line in a triangle have one positive and one negative slope, the support and resistance lines of a wedge would both either a positive or a negative slope. So to me, I just call them triangles also. We have ascending triangles, descending triangles, ascending, descending, symmetrical, and then we have, I just call them wedge, triangle, wedges, and reversal and continuation, whether it's moving up or moving down. But they all work the same as a triangle. So what do we have? We have triangles, channels, rectangles, wedges, and then we have one of the most unique of these, which is called a head and shoulders pattern. Head and shoulders happens to make the press a lot, so you hear about it a lot. And when a head and shoulders actually develops in trading, it's quite important and quite reliable. But before we go back and talk about head and shoulders, I've got a little presentation that's going to go over the differences between wedges and channels and how you would look at them. And then we'll go on with Talking about a head and shoulders.
We take a simple wedge pattern, right? So price is, trapped between this wedge. I'm looking for consistent touches on both sides. I like a market that is very accurate. So it's really respecting these two areas. Again, I apply that concept to all breakout patterns. So, for example, let's say we take a box breakout, right? So the same principle where I want to see really nice touches of the tops or bottoms. And for example, if one of these areas has better touches than the other, that might actually be the area that I become biased towards trading. So let's say we take the same box breakout here, where we could say, okay, the market might break out either way, but let's say the bottom of this box has touches that sort of look like this. The market, kind of touches, maybe overshoots a little bit. But let's say the reverse side here, that the top of this box is very accurate and all the touches are nearly pinpoint to this top of this box. Well, I tend to move towards looking to trade the breakout long rather than short because the accuracy of this area makes it easier to trade. So that sort of general concept is what I apply to almost all breakouts. Whether it's a head and shoulders pattern or a wedge pattern or a falling channel, ascending triangles, whatever the pattern might be. That's one of the sort of filters that goes through my mind when I'm trying to limit down what I'm looking at. So again, if AutoCharters populates out 60 things to look at, well, we can't watch and follow all 60 things. So what I do is, again, I'll use their quality indicator as I showed you guys. I'll use the length indicator as I showed you guys, and then I'll use the visual indicator from my own experience to limit it from there as well too. So that's sort of a general look at breakouts. Now, how do we trade these breakouts, right? So I've shown you guys a few ways to trade them. I've shown you what I call preemptive breakout bars, and again, we're going to go over that in a little bit more detail now, more abstractly, as some of you might even have not really even understood what I was talking about, and that's okay. And I've showed you another type of entry, which is using a wick bar. Again, there are multiple ways to do this. For this video, though, let's focus on preemptive breakout bars. And the reason I'm going to focus on them is because they are my favorite. And I say that because they tend to be the bar that I play the most. They're very simple, and it gives you another additional filter to entering your trades, right? So, for example, how do you know when to enter? Do you just enter when this market breaks out and closes above here? Do we just buy and then hope price goes up? Likewise, do we just enter when price breaks down here, and right as it breaks these lows, do we just sell? Do we want price to close X amount of distance away? So there are a variety of ways that I'm going to show you guys how to enter into breakout trades. And again, it's situational, right? Not every situation is the same. And as a trader, don't treat every situation as the same. But what you do want to get going here is rules to guide you. And these rules are when put into place are going to make you a consistent trader and are critical to long-term success. Again, along with being disciplined and all the other things that you need to be: patient, disciplined, consistent. I mean, without those as a trader, you will not see long-term success here. So let's go over, in this video now, let's go over just preemptive breakout bars. And it's actually very simple. So a preemptive breakout bar to me, or a preemptive breakout situation, is sort of just before the breakout occurs, right? So let's go back to and use a simple triangle example, right? And let's say we really don't have a bias which way price is going to go. Again, sometimes we're going to have that bias, and we'll see those situations, right? So we've done that where we're looking at a falling wedge, and we're saying, okay, our bias is to the upside, because falling wedges tend to break to the upside. That's sort of what the pattern is indicating. But then sometimes you have side-to-side patterns, whether it be a box or a triangle pattern that's just sort of dead flat in the market, and the market might break out either way. So a preemptive breakout of this situation would be before you get that big breakout, right? So, let's say price again is consolidating down, we're looking for an entry, and before the breakout actually occurs, before the big move either down or up occurs, right, which is what we're looking for an entry point into this marketplace. So what I do here is I take simply a few different price action bars that I look at and we teach in the group, and I apply it to this situation. So for just this video, and again, you're going to see other bars are applicable, I'm going to utilize outside bars for this video. I'm going to utilize outside bars and double low higher closes and double high lower closes to explain what we're looking at here. So let's just explain the bar setup first and then apply it to a breakout situation. And then again, I want you guys to go back and utilize AutoChartist, the pattern recognition software for you, and go and look for these situations and just start to watch them and see how much more accurate you can be, how it helps you with your stop loss placement, your entry, and we'll start to give you a rule set to guide you through these breakout trades. So let's start with outside bars. So again, I've already explained these in videos, but now you'll have sort of a general abstract video to come back to if you get confused. So outside bars are simply engulfing bars, right? So let's say, for example, we have, this is a bearish bar, right? Let's just say price opened here and it closed here, okay? So for an engulfing bar to occur or an outside bar to occur, we have two types. We have a bullish engulfing bar and a bearish outside bar. So both of those bars indicate different movements. So if we have a bullish outside bar, that bar would engulf the previous bar. So it would have a lower low than the previous bar. It would have a higher high than the previous bar. And again, it's going to close generally in the upper portion. So we really want it to close in the upper quarter of the bar. So, you know, anywhere from say here upwards is going to be considered a bullish outside bar. And reverse, likewise to the downside here for a bearish outside bar, let's say, for example, here's a bullish bar, just a regular old bullish bar. And then the next bar engulfs that bar, has a higher high than the previous bar, a lower low than the previous bar, and again closes near sort of the bottom of the bar here. So these are just engulfing bars, right? So you have a bullish outside bar and you have a bearish outside bar. So when now we're applying this outside bar situation to a preemptive breakout situation, or this is what will be a preemptive breakout bar or a trigger bar here. So let's go back to that same wedge situation where again price is consolidating down, right? So we're looking for a breakout. We're looking for a tip off here. So let's say we move this bearish outside bar into here. It would look something like this, right? So let's say we have a bar that kind of just sits here, maybe bounces off the rising trend line, and then that next bar maybe engulfs that bar and closes outside of the pattern. So price is just starting to break out, but it's also giving us a bearish outside bar. So what does that bearish outside bar tell us? It tells us a lot of stuff, right? First of all, it tells us price tried to break long, right? And sellers rejected us down and closed us underneath the previous bar's range. And again, sometimes you have many more bars before this, right? You might have another bullish bar, you might have a bearish bar, and it might engulf that entire range. So now we're getting a preemptive bar telling us, signifying that a breakout might be coming here, right? So now we know, okay, listen, instead of just outright buying or selling, we're going to sell because we have a price action trigger. So let's look at this situation again a little bit closer. Again, here's our wedge, right? Price is consolidating down. So you get the new trader who says, okay, I know a breakout might be coming. What should I do? Well, let's say this happens, right? Price starts to move higher here and starts to break out, right? So people start buying. Then what happens? Next bar, price moves back into this area here. So now you got trapped, right? So how can we filter ourselves out of this situation where we're buying just on a break? Again, let's apply the outside bar situation. So once again, let's take that wedge, right? Let's show price consolidating down. Let's show price start to break out here, right? And let's say here's the last touch to this descending trend line, right? Let's say that's a little bullish bar right there that closes right there. Then let's say that next bar, right, opens right here. Price moves higher, so it starts to trigger in buyers, and then what happens? We collapse down. We get a bearish outside bar that now false broke out of the top trend line and now is indicating a move down. Well, instead of hopping on the buy here without any sort of information and just hoping the breakout sustains, let's utilize this bearish outside bar as a trigger point or a preemptive breakout bar to signify a move down. So this is the type of trigger that I look for in a lot of situations, whether it's a box situation, a channel, a flag situation where price is ranging. So I'm looking for these preemptive breakout.
So as you can see, there are different ways that we can watch for that breakout. Now, like I showed you in the Bitcoin chart, we had a false breakout And then we had the really positive breakout, and we did there have a bullish engulfing pattern in the candles. But the biggest clue you're going to get is volume as well as your support and resistance lines. You don't want to trade a triangle when it just breaks out. You need something to tell you that this is a valid breakout, not just the bulls getting a little excited for a second and then collapsing back into the triangle. But once you've established that it is a solid breakout, we then want to use it to set our support and resistance, to set our entry points, our exit points, and there are standard calculations we can do that. Okay, so again, it is finding the breakout and then, or validating the breakout, and then being able to trade that breakout or use it to set our levels. Now, also, I mentioned in that video auto charts. Now, auto chart is a paid for scanning type service that will send you all kinds of notifications. Now, tonight, we're also being powered by investing.com. Investing.com also offers chart patterns that you can customize and set up and get alerts. You can set up the assets you want to track on investing.com, tell them what type of patterns you're looking for, what time frames you're looking at, and it will give you alerts, customized alerts and notifications when the particular channels you are either developing or have just concluded. Okay, so you'll be able to see that there's a rectangle forming or a triangle forming, and what bars. And if you tell you're only trading, you want to only see a rectangle that's forming on a 15-minute chart, you can say a 15-minute, a 30-minute, 1 hour chart. It's going to keep, and it'll just send you the notification so that you can then put it and see it on your charts also.
Let's focus on how we can trade these patterns to increase our trading equity. There are a few techniques that can be employed to trade these triangles, irrespective of what type of triangles and whether we are buying or selling. In this example, let's focus on a long setup. If a triangle is applied here, we can anticipate a potential breakout occurring to the upside due to the overall uptrend conditions the market is in right here. A long entry may be taken at this point here. A stop loss placed potentially below the triangle bottom or below a previous swing low, depending on the trader's risk tolerance, which is relevant to one's account size or emotional level. Now, the great thing about trading with triangles is that they involve a level of symmetry with the market. Generally, one can calculate a potential exit point by this strategy working with the parameters of the triangle that already have been formed. For instance, measuring the distance between the highest point formed within the triangle and then the lowest point can provide a distance of measurement that can be employed for an exit strategy. To highlight this in practical terms, the distance measured here equals roughly 70 pips of movement. On many occasions, if the price breaks to the upside, there is a level of symmetry that comes into the equation. Potentially, you might have the market move 70 pips higher from the point where it broke out of the triangle. So using the length of the triangle to determine an exit point is a common approach when trading with triangles. Look at how the market hit that target of 70 pips at this point. Let's now look at a different technique one can use to trade with triangles. For a short setup, once the triangle has been applied, and one expects at some point that the market will break out and make new lows, one can enter their sell order at this point right here. A stop loss can be placed either above the triangle or above a previous high around here, ensuring a small risk if the trade goes up instead of down. A trader can use the lines that form the triangle to guide them to an exit point. For instance, take this upper line, which is sloping down. Double-click on the line itself. Hold down the control button on the keyboard, and this will duplicate the angled line used to form the triangle. The key for creating a duplicated line is to connect it to the lowest point within the triangle at this low right here. This provides a guide for the trader to close or exit their position once price goes near the line, which will act as support, which indicates a time to react. Here is a long example of how this works. Symmetry is everywhere on the charts. They are emerging patterns that reoccur over and over. It's about recognizing the right environment where the symmetry lies in order to use its application in real-time trading. Using the symmetry, distance, and slope from these triangle formations to govern these trade setups can be applied to a 1-minute chart or to a monthly chart. Defining the direction is the key when applying the parameters of the triangles to create setups of these support and resistance areas.
So as you can see, there are some fairly easy ways to use triangles or chart patterns in your trading. It's not very complicated. You just have to start using them and practicing with them. And that's the key to chart patterns all. Seeing them, recognizing them, building your own little strategy of what you're going to use to verify your breakout. But the philosophy of the target point, the entry point, the exit point are standardized. You know, you can adjust them on your own, but this is a standard method that's been used in the industry and used by Forex and CFD traders for many, many, many years. It's not something that I'm coming up with or somebody else is coming up. These formulas and these entry and exit levels are standardized. Now, we also go over to one of the most interesting patterns. It's the hardest to see, but when it occurs, it is very, very reliable. And it's got a funny little name, head and shoulders. And that's because it looks like the head and shoulders of a human being. Now, for every move up, there's always a mirror reflection, whether it occurs in an uptrend or a downtrend. If it occurs in a downtrend, then it's an inverse head and shoulders, and it's just flipped over. So tonight we're going to talk primarily about the head and shoulders from coming off of an uptrend. Okay, and that's the standard head and shoulders. But you just have to mirror it for the inverse, which would come off of a downtrend. And a head and shoulders pattern takes quite some time to develop. And you won't even notice it till it's almost over here in his last inkling, because you don't even see it at that point. But what happens is when price is moving up, it comes up and hits a resistance level and bounces off of that resistance level. It comes down to a support level and bounces off of that support level. It then moves up to it breaks this resistance level and moves up to its next resistance level, but then comes back down to that support line, bounces off that support line, comes back up to its previous resistance line and bounces off of it. Now, once it bounces off, at this point, we can prepare to say that we have a good head and shoulders, but not that we have a reversal yet, because a head and shoulders is a reversal pattern. When it breaks this support line, that's when we have the reversal at this point. So you wouldn't even consider a trade until it came through that point. Now, so price moves up and forms what's called the left shoulder. Comes back down and finishes the development of the shoulder and moves up to form the head. This green line here that we were talking about being a support line is called the neckline. So if you imagine as being the head and shoulders of a person, you form two shoulders and your head is higher than your shoulders. Now, there's all types of formulas out in the market but how much larger the head has to be than the shoulders. I pay no attention to them. These are individual gurus who have come up with their own calculations. I say a head and shoulders pattern is like a human being. Some of us have long necks and round and oval heads. Some of us have short necks and rounded heads. Some have high foreheads and low foreheads. It just has to be above and make the form that looks like a head. The rule of thumb is the shoulders must also be at the same resistance level where they bounce off and turn down. I again say you have some people that are bending over to the left, some people that are kind of cockeyed. You have somebody who might be tipping in under. So they don't have to be exactly the same. They have to be relatively the same. So again, I say it's like looking at a human being. They've got to look symmetrical, but not perfection. So because it's easy in a diagram to have it, but when you're looking in the real world of trading, nothing is that easy to see and nothing is that concrete. So in other words, here we have price moving up, came over the resistance line, bounced off the resistance line, came back down to the support level, went back up, broke that resistance level and came up to the new resistance level, came back down to that support level, came back up to that resistance level. And at this point, we have left shoulder, head, formation of the right shoulder. And at this point where it breaks the neckline, we then have a full reversal pattern. So it means this uptrend has now reversed into a hardcore downtrend and gives us a short opportunity to sell. Now there's a standard formula to actually figure out what your target points are and where to put your stop loss and where to enter the market. So this formula is T, which is your target price, is equal to the neckline minus the head minus the neck. So whatever price the head is, that's the highest price that asset hit before it went down to form the head. Okay, and the neckline is the support line. So what we would do is say, hypothetically, say the neckline formed at 10, the highest point of the head was at 15. So in order to get our target point, because we would be entering a sell, at this point we would take our target point would be N, which is the neckline, it's 10, minus the head, which was 15, minus the neck, which was 10, and that would give us 10 minus 5, or 5. So our target price for our possible trade would be here at 5. Because you need to have that target price to set your risk-reward ratio and calculate when you'd want to exit the market. Your sell signal will be generated when price broke the neckline here at the end of the right shoulder. And like I said, coming off of a downtrend is exactly the opposite, and it's called an inverse head and shoulders. Then we have other patterns that occur. We have double tops and double bottoms. I pay absolutely no attention to double tops and double bottoms, only because they happen so often, especially in Forex and CFD markets. You'd spend all your time looking at double tops and double, and it's not enough movement to be significant for us, the type of trading we do. Because a double top or a double bottom just means price went up to a resistance level, bounced off it, came back to the support level, bounced off of it, came back to the resistance. But two bounces is not so significant that we want to make any trading decisions. But from here we go to the triple tops and triple bottoms. And triple tops and triple bottoms are reversal patterns that touch either the support or the resistance line 3 times before reversing their trend. This is a stronger indicator of trend change than a double top or double bottom. Look for a strong initial trend and a significant breakout in order to confirm reversals. And triple top has a very standard calculation, a very easy calculation. It's the target point would be S minus H, would be the support level minus the highest point or the top of the resistance level. And that would give you the target point. Not difficult calculations. Same thing is true for the reversal for the triple bottom. Now, one of the most important things to understand is that trends are very important. It's the quality of the trend and the quality of the pattern that will help you make the decision. This is why I say you can practice these a lot, because you'll see triangles develop a lot, but they don't have very good quality. You see trades all going on inside and price action all inside, and there's no quality to the trend. You're either not in a strong uptrend or it's an all over the place. And since we're only looking for high probability trades, we're looking to filter out every bit of garbage trading out there. That's not saying that you couldn't have made that trade and made a couple pips. We only want the trades that can offer us the highest potential profit with the smallest risk. Okay. It's not about how many trades you make. It's making the most highly probable trades. Okay. So the quality of the trend and the quality of the channel, or the well-formedness of the pattern, will help you decide how much validity you want to give. Also, the quality of the trend and the quality of the pattern, the well-formed, will also serve to help you better calculate the momentum and to figure out how much that momentum is going to carry that price when it breaks out. Now remember, a pattern is said to have broken out once it has crossed either a support or resistance line. If the pattern broke out in the same direction as the preceding trend, it's called a continuation pattern. If the breakout is in the opposite direction of the reversal of the trend, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it is a bullish signal, that is, the breakout went through the resistance line upward. Because it's a reversal pattern, that means the preceding trend was in the opposite direction as the breakout. So the preceding trend was bearish, and when it broke out means it went from a downtrend and reversed to an uptrend. So there are simple ways to trade all of these patterns. They will all give you entry levels, take profit points, stop loss points, and they're all the same. Okay, it's simply the width of the triangle and the width of the pattern and the quality of the pattern and the trend line you're looking at. I've explained this all to you in that handout. I've given you step-by-step procedures and calculations and everything else you need to figure out how to use these in your trading. So thank you very much for joining us tonight. I hope you learned a little bit of something. It's only a guideline to get you started thinking about things, but chart patterns are not very difficult. They're harder to spot than they are to trade. But again, if you use investing.com and set up your scanning information on their chart patterns, or if you use something like AutoChartist, or there's a lot of downloadable scanners out there, because computers today can look for everything and they'll just let you know when these are developing, and then you put them on your own charts and make up your own minds. So thank you very much for joining us. And if you want to learn more about using patterns, or you want to set them up on the charts, if you go to www.alvexo.com, you can use their advanced charts and set up the chart patterns right on their charts. So thank you very much for joining us tonight, and we'll talk to you again real soon. Have a great trading week. Bye now.